The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Small cap stocks outperform for a fifth straight day. The contours of a year-end rally taking hold. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele. You know what I'm going to say, right?
No.
If we close at a record high.
Oh my gosh. Wait.
52. We closed at a record high. We'd have to get over 6,001 to get there. So maybe not today, but nonetheless, we had a pretty powerful rally. We did hit an intraday record high. We're now off that level of 0.2%. But as Romaine was saying, you got the Russell, you also got mid-cap index, all at record highs today. And a big part of that is being led by lower yields on the back end. The whole curve pretty much now flat on the day, Romaine.
Yeah, and it's kind of fitting that we're starting off at a record high. Goldman Sachs trader Scott Rubner came out with a note prior to the start of trading saying that this was likely going to be the start of a year-end rally that should push the S&P up 4% to 6,200 as retail buying accelerates. You throw in corporate buybacks, and he sees a path to build on what has now been the largest three-month inflow into U.S. equities since 2021. Even frequently bearish Mike Wilson can't find much to quibble with.
We've been excited about this for 6 months. It's just now we can kind of see it in a way where we can see a broadening out. We see it in the numbers, right? We've been waiting for this.
And while stocks surge, the two-month bond market sell-off, that's actually abated for now. Investors, they have started to swoop in whenever those yields did test new peaks. That 4.5% top on November 15th for the 10-year, looking like it was a major catalyst for that reversal in sentiment and buying. Now, to be sure, this is a far cry from the full-on embrace we're seeing in equities, as bond traders are still cautious due to uncertainty around Trump administration tariffs and fiscal stimulus. And I want you to keep those last two things in mind, because the decision by President-elect Trump to nominate hedge fund manager Scott Bessent as the next Treasury Secretary, it's an intriguing one. His markets experience, certainly a plus, but his reputation as a fiscal hawk could complicate things, as he will play a key role in overseeing the government's hefty debt sales, thus giving him a key role in the direction of interest rates.
Yes, it definitely will. But let's get back to that first point, Romaine, and that's sort of the surge that we've seen within the equity market and the amount of flows. Here's another way of looking at it. So this are fund flows for the VOO index, that is Vanguard's S&P 500 ETF. I mean, this move, though, so far in the last few weeks has been tremendous. We're looking at $18 billion so far this month, almost $20 billion of net inflow in this month alone. And you can see ever since the election, or right before the election, a big increase as well. So my question always is then, does that actually sustain itself? Or is this just kind of re-end reshuffling? We already saw Barclays upgrade its 2025 forecast from 6,500 to 6,600. So is there more room to go, Romaine, or is this a little toppy at the end of the day?
Yeah, that's the big question here as we kick you off to the close. Afsaneh Beschloss joins us right now. She's the founder and CEO over at RockCreek. And Afsaneh, when you look at, I guess, the quote-unquote animal spirits that have been in this market, at least for the last 3 weeks or so since the election, and even slightly prior to that, can we pin this on the election? Can we pin this on optimism for that new administration that takes shape in January?
So, Romaine, I think we have had a very big rally this year in terms of equity markets. And what has happened, of course, we saw Magnificent Seven being up, by 55% this year? That was long before the election. Around the election time, there was uncertainty and which way is the election going to go and what will the impact of the election be. And obviously, with the kinds of promises that President Trump had made, and most recently in the last day or two with the selection of Scott Bessent, which has been positive for the markets, there is definitely another push for markets to be joyful.
So, well, let's talk about kind of what sustains this, because it's one thing to be hopeful for potential things that actually haven't happened. Of course, as you also know, at some point, you've got to make good on those things, and those things have to flow through into corporate earnings and into economic growth. Do you have confidence that we'll see that?
I think I would look at two different forces going on. One is the force of what is going on in our economy that has been propelling it forward, which is AI, sort of the new knowledge economy, together with power, data centers, energy, all of those things. Those things have been going on for a little bit, and I think unless someone messes them up, I think those will be big forces for growth in the U.S. economy, and for the reasons that we've seen the flows that you just talked about. The other side is what will be the economic policies of the new government and Scott Bessent and his and others who are going to be running the economy. I knew Scott a little bit a long time ago when he was in his previous life, and he is one of the best market makers and one of the best traders and macro thinkers. And so the question is, he made a lot of money understanding what policymakers in Japan, in the UK, in US did, and trying to make trades that took advantage of policymakers' decisions. Now that he will be a policymaker, he has a lot of experience to sit on the other side and see how his policies will impact the economy, how his policies will impact markets in a way that really very few have. So I think he certainly is in a very good position to do that. He also will have at this time Jay Powell in the Federal Reserve, who's watching the numbers. And I think if they work well together, that could be quite powerful for continued growth.
And then it looks like maybe Kevin Warsh, once Powell's term is ended, so maybe that in as well. So Afsaneh, does that mean that you should stay in the U.S. equity market and that joyfulness will continue, or do you need to be more discerning in that joy?
So I think with the equity markets, I think those forces move us towards sort of a positive outlook looking longer term into 2025. And the other force that is happening is how China is self-destructing. I don't mean just because of tariffs, but because of the policies of President Xi. So that China, while it might have done well in terms of its equity markets over the last year, in general has not been a go-to place for investors, and really will not be a go-to place for political reasons, but for economic reasons moving forward. Similarly, other parts of the world have not had the kind of returns that the U.S. has had, and the kind of things that we just talked about, which are more likely to bring more capital into the U.S. So I think all in all, we are in a good place for the U.S. economy to continue doing well and for the markets to continue to do well here. But I should also just mention that big institutional investors are reducing allocations to equities a little bit just to rebalance because, the markets have done so well.
And when you say that the U.S. can continue to sort of outperform, is that going to be on a broad index level, or does it also count for, say, value in small caps, like the nuts and bolts of the economy? Does it also work there?
I think probably both. We saw, for example, the small cap markets being up today. I think what will happen in the U.S. is obviously it was the larger stocks, it was things that were related to AI that did well. But now with deregulation, what we're going to see is that smaller companies can prosper in a way that smaller companies often get more stifled by regulation than larger companies. So that could be another force to help the small cap and other kinds of markets to do better than we expect, plus everything else that brings them up. Obviously, in this kind of market, there will be a lot of losers too, because companies that will not be able to have the right earnings will get sort of hurt, and we should just watch out for the stock picking. So the value. So I would look at momentum, but I would also look at value carefully.
Do you find value, though, right there? I mean, because Afsaneh, a lot of people are looking at this market. I'm specifically talking about the U.S. market, and they're predicting all these extra gains. But some of those same people will then talk about how overvalued, at least on an individual basis, a lot of these stocks are. So kind of square that circle for us.
So let's just take the utility sector. In terms of power and the amount of power that we will need in the next few years, every single utility company will need to be making more investments. Those who do better, those who are faster with diversifying their sources of energy and moving faster with the use of technology and AI, but also maybe getting into modular nuclear, will do better. And the forces are huge, I think. I think it's something that, again, started a few years ago, but the momentum of that force could be enormous for certain sectors, but again, not for all sectors.
All right, Afsaneh, I have to leave it there. Always a wonderful conversation. Have a wonderful Thanksgiving holiday, and we'll catch up with you soon again. I'm sure Afsaneh Beschloss over at RockCreek helping us kick you off to the close. A lot more coverage coming up right here on Bloomberg.
Staying with outlooks for 2025, JPMorgan sees dueling boom or bust narratives evolving in the market. On the one path, they see tax cuts and deregulation unleashing animal spirits, while the other path foresees policy uncertainty hurting growth. Joining us to discuss, Michael Feroli, chief U.S. economist at JPMorgan. That's the narrative that has evolved since the election, right? Where do you guys stand in that narrative?
Well, I think there's truth to both of those. I think in reality, we may see something that ends up pretty close to in between, which is, we have this economy right now where we have seen over the past 2 or 3 years growth gradually slowing, inflation coming down, and we project that that's going to continue into next year, that we're going to see somewhat softer growth than we've been seeing, in part because of slower growth in the labor force. But we also see some continuation of the disinflation, albeit now with this curveball here of potentially higher tariffs adding to some inflationary pressures. But overall, we do think inflation a year from now should be lower than it is now.
Low enough to get more cuts from the Fed than we're pricing in. We're only pricing in like 2.5 now through the end of next year.
Yeah, we only see 4 through the end of next year, which is maybe above the market, but certainly fewer cuts than we were thinking just a few months ago. Very near term, I think what we see in late December is going to depend on what we see late next week with the November jobs report. But then after that, I do think there is reason for the Fed to go a little more cautiously here, given all the uncertainties that have been thrown into the economic outlook, including, as I mentioned, trade, immigration, fiscal policy. We don't know, first of all, what the policies are going to be. Mm-hmm. And then once we learn what those policies are going to be, there's still uncertainty as to the economic outcomes.
I am curious as to how quickly the Fed can react to that. The last Fed press conference, Jay Powell was asked about this, and he kind of made it clear they'll react once the actual reaction happens, more or less, is kind of what he said. Now, I'm not sure I completely buy that, but there's this idea that there's so much policy uncertainty, not just in what's going to be implemented, but how it's actually going to affect the economy. Yeah. This is all you do. This is what they pay you to do. Right. Can you, I'm putting you on the spot, how is this going to affect the economy? Because there's so much debate right now. Yeah. I mean, let's just start with tariffs, because that seems to be the one that's a lot of people are concerned about. Yeah. We feel like Trump is going to go forward with that. Right. That doesn't necessarily mean that's going to be necessarily bad for the economy, does it?
Well, so I think classically we kind of tend to view tariffs as similar to an adverse supply shock. So it pushes growth down and it pushes prices up. That being said, the lesson from 2018, 2019 is that the magnitudes may not be overwhelming, right? There's a lot of forces going on here in the business cycle. So not everything is determined in Washington. Now, we do think, as I said, that it could add to some of the inflationary or slow the disinflationary progress we've seen. I think it's harder to gauge the impact on output and on growth. And again, maybe that's where the sentiment effect is offset by the more positive effects from deregulation.
And of course, the last time around in the Trump administration, one of the bigger concerns when it came to tariffs wasn't just the tariffs we were imposing, but of course the retaliatory tariffs and how that would have. I also want to ask you about the immigration component. We've already heard from a lot of companies that do depend on migrant labor, whether legal or in some cases illegal, and they've made it clear that there could be pain, whether you're manufacturing, whether you're in farming or food production or something else here. Is there a way to quantify that on an aggregate basis as to what the potential impact could be?
Yeah, so we think over the past 2 or 3 years, the surge in immigration we've seen has probably added something like, on average, 100,000 job monthly to the jobs report. So a lot of those 200, 300 numbers we've been seeing over the past couple of years. Yeah, you'd want to take.
And I've heard people say that. It's something the Biden administration, of course, didn't tout. Yeah. But it seemed like a lot of economists were saying that's where the growth is coming.
And that could be worth something like a 0.5 percentage point on GDP growth. And we're talking about now aggregates and not per capita or welfare implications here. But it should, I think everyone agrees, should slow the pace of job growth and overall economic growth. I think the bigger uncertainty, at least for a lot of people, is what it means for inflation, right? So what we have seen has probably eased some of the tightness in the labor market, but it's also probably the case that some of the tightness we've seen in the housing markets and in rental markets are also an outcome of this big surge in immigration. So where those two shake out, there's some debate.
So if you reduce immigration, then you reduce some issues of the housing market as well.
Well, so what I'm saying is when we add immigration into the picture, you're adding labor supply, but you're also adding consumer demand, right? Because they're getting paid and they're generally spending. So it's, how will you balance that when you flip the sign, I think is a big question. And there's not a lot of consensus.
I thought about it on the flip side, so that's an interesting way to flip it back. The other sort of leg of the stool is what happens with the dollar, right? President Trump makes no bones about the fact that he wants a weaker dollar, yet I keep reading about how difficult that will be if you impose tariffs, et cetera. What's your best guess?
So we think the dollar does strengthen here. The textbook says, when you put on a tariff-imposing country, their currency should appreciate. And we think the textbook is probably correct here, particularly if you're going to see a Fed that is not as accommodative as people thought, or as dovish, let's say, as people thought, a month or two ago. So it will, I think, make things difficult, again, for Powell and for everyone involved. His new Treasury Secretary, who in principle has dollar policy in his remit, I think is going to have a really difficult balancing act here.
I am curious, particularly on the Treasury side. I mean, there's obviously a lot of concern about the fiscal situation, the amount of debt that we already know the Treasury needs to issue. And the big question is, how much does that go up? Or do we get policies coming out of the White House that maybe interrupts that issuance, maybe for good reason? But how does the Treasury Secretary navigate the needs to effectively, pay our bills and finance other things, with the desire, of course, to curtail spending?
Yeah, I think it's going to be really tricky. I think simply extending the Trump tax cuts, you're talking next year, in 2026, a deficit to GDP of around 7% at least. Now, if you add some of the other things on tips, Social Security, overtime pay, obviously worse, maybe you can counter that with some cuts in spending. But when you start to take away interest, defense, Social Security, Medicare, it leaves not a lot of space to really deliver on something that will get you to a deficit to GDP. Certainly, I think the 3% that's being floated by the incoming Treasury Secretary looks really optimistic, let's say, in the next couple of years.
So to round it out, what's going to be neutral over at the Fed?
I think you're probably looking at something with a 3 handle, right? Without getting, I think putting a point something on is getting unduly precise. But I think in a few weeks when we get, I guess it's 4 weeks when we have the next Fed meeting, we'll get an update on their estimate of the longer run. And I suspect they're drifting. Right now they're around 2 3/4. I suspect they're drifting closer to 3 over time, if not higher.
All right, Mike, always great to talk to you. Very measured and a very great report out of Michael Feroli, Chief U.S. Economist over at JPMorgan. A look here at what's going on in the economy and how it's potentially affected by the new administration taking over in January. We want to pivot from that to our top calls. These are the big movers on the back of analyst recommendations here on this Monday afternoon. And we start off with Mara Holdings. This is Marathon. They changed their name. Barclays starting coverage of the crypto mining company with an equal rate rating and a $27 price target. The analyst expressing some skepticism about investors using mining companies as a way to gain Bitcoin exposure, but says if that's the strategy you want to take, well, Mara is the most efficient company to do it through. Shares unchanged on the day. Next up, let's stay with crypto. Robinhood getting an upgrade to overweight over at Morgan Stanley. The analyst saying the trading platform will be among the biggest beneficiaries of Trump's presidential victory. The analyst specifically sees sustained trading among retail investors as crypto support is set to broaden in Washington and animal spirits are revived on Wall Street. He sets the price target to a street high $55 a share. Those shares moving higher by 2% on the day. And finally, Five Below, a downgrade to market perform over at Telsey Advisory. Joe Feldman, the analyst there, telling investors he's not a fan of the discount retailer's outlook, which clouds visibility, though he also flags proposed tariff increases under Trump that would pose a significant risk to sales and profits, given that 60 to 70% of Five Below's products are imported from China. Investors, well, shrugging that off, pushing the shares higher by more than 6%. And those are some of our top calls. China was also a big focus of another call out this morning, this one on consumer staples brand Procter & Gamble. D.A. Davidson lifting its rating to buy from neutral and noting the improving sales conditions in China. The analyst behind that call, pleased to say, joined us right now. Linda Bolton Weiser is managing director and senior analyst covering health, beauty, and leisure over at D.A. Davidson. I haven't heard, Linda, a whole lot of analysts making bullish calls specifically tied to China. But you obviously see something here that maybe other investors haven't quite warmed to. Give us the quick and dirty.
Yeah, sure. So Procter & Gamble actually has one of the larger China exposures in the HPC space. So Procter has about 8% of annual revenue in China. And so it has been a weak spot for them in recent quarters. But at the analyst meeting they had in Cincinnati last week, they noted that Singles Day was actually in line with their expectations. And they're kind of noting that trends in China now are more in line with their expectations rather than being disappointing. So that doesn't mean that it's growing yet, but they pointed more to a down mid-single digit Singles Day type performance rather than down 25%-ish like last year. So their comments kind of indicated that maybe their business in China is starting to trough, to make a bottom. Even though it's not growing sequentially yet, it could be bottoming. And most importantly, too, SK2, which is a big skincare brand for them in China, it launched a new product in September, and SK2 sales for them in China have been up year over year since September. That's a significant change.
So is it possible that China does become a growth story for P&G? I know they still get a big chunk of their sales from the U.S., a big chunk from Europe. China's still a relatively smaller percentage of that. Do we see that share, China's share of P&G revenue grow?
Well, I think Procter is committed to the market longer term, and they see the growth potential there longer term. But as I said, 8% of revenue or close to it at this point, they do have one of the larger exposures. And they do caution that, you know, it's going to be at least a few quarters, many quarters out before you could say this is a growth market for them again. But I'm just sort of trying to call that, hey, maybe you're at the point now where it's not getting worse.
Right.
That it's actually meeting the expectations that they are projecting.
Right. So not worse. Not better yet, but not worse. Okay, no, fair enough.
Right.
When you try and look at a Trump administration and tariffs, and then if we see any corresponding tariffs out of China, how do you think about that or model that when it comes to Procter & Gamble?
Sure. The company did address that in the Q&A session last week, and they pointed out that the whole economic model of Procter & Gamble is to produce as close to consumption as possible. So really, you don't have a situation where there's a lot of things kind of being made in China and then being imported into the United States. That's just not the case, really, with most HPC companies.
Okay.
So I do think that they're probably less exposed than some other types of companies. And also, they just, you know, commented that strategically they have a lot of flexibility built into their supply chain because they do manufacture and source from so many different regions of the world.
That's a fair point. Before we let you go, specifically for P&G, what is an execution risk for this company?
Well, Procter has actually been executing extremely well in the last few years. So I think that for them, there's not as much company-specific execution risk, and the risks are just macro at this point. So they have about 15% of their revenue base, which has been problematic, but that's been the Middle East, certain African markets, and of course, China. But the rest of the business, 85%, they are executing extremely well.
All right, Linda, we really appreciate it. Thank you very much. Linda Bolton Weiser over at D.A. Davidson. I should point out Procter & Gamble is at a record high. Consumer discretionary in general is doing really well for the S&P.
And I forgot they own SK2. Which is
Me too.
Which is actually a brand that does well, at least in the zeitgeist. It's doing very well. So apparently that could potentially be a growth driver in China.
Yeah, but I thought your point was a good one, that like you get the majority of your revenue anyway from North America and from Europe. So like what does China have to grow to, or Asia have to grow to really be a good growth driver? But I guess less bad deserves a record for the stock.
Yeah, well said. Yeah.
At the end of the day. All right, coming up, a conversation with Ruchir Sharma, chairman of Rockefeller International, about what a Trump win means for the state of capitalism. It's no light conversation, but we're going to break all that down and what it means for the rest of the world. Let's take a quick check in here, though, on markets. You're taking a look at the S&P up 0.2%, no longer at a record, but it did kiss a record earlier today. And commodities also coming out here. You have oil down by 3%, Romaine.
Yeah, and you see the big bump in natural gas here in the U.S. And look at coffee futures, actually off the highs, but we saw a big rally there, particularly on Robusta. I think you're looking at Arabica there or here. So I don't know, you're a coffee drinker. You got 3 cups of coffee.
Arabica, not Robusta. We like the Arabica.
Arabica?
Yeah, the fancy stuff.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Boston.
And I'm Alex Steele, and we are seeing equity still higher, but it's things like real estate. You also have home builders doing well, all because those yields are so much lower.
The yields are lower here, and you're seeing that reflected, of course, in the outperformance in a lot of those small caps, the cyclical names. Russell up again for outperforming again for another day. The S&P equal weight outperforming again for another day. So shouldn't you be happy? Isn't that what we wanted?
In theory, but I guess the question is why. Ira Jersey, Bloomberg Intelligence, was saying that he thinks that Scott Bessent over at Treasury would just be 3 basis points worth on the back end, and that really what we're seeing is some short covering headed into the holiday week. So maybe you can't believe it all. But let's stay with the aftermath of the U.S. election. Ruchir Sharma writes in the Financial Times that Trump's victory represents an historic protest vote, not necessarily on the left or right, and has become the new majority. It is a revolt against long-term rot in post-capitalist economies. Here in studio with more is Ruchir Sharma, chairman of Rockefeller International. He's also the founder and CIO of Breakout Capital, an investment firm focused on emerging markets, and the author of What Went Wrong with Capitalism. All right, Ruchir, explain the thesis.
Well, the thesis is this, right, which is that if you look at the developed world today, what you find is that most incumbents are losing elections. We saw that in places like UK, in France, or wherever you go, incumbents are losing elections. This is not how it used to be. About 5, 10, 15, 20 years ago, if you were the incumbent, you had a natural advantage. So as I wrote in the column, this is the first time in over a century that the party in power in White House has lost 3 elections in a row, right? So something different is going on, where there's a lot of anger at whoever is in power. And it's not about left or right, because you've got governments in different parts of the world where if the right was in power, the left has done much better. So this is not ideological so much as the fact that you're protesting against whoever's in power. And the reason I cite for that, and something which I've mentioned extensively in my new book as well, is the fact that there is deep unhappiness at the average level about how capitalism is working for the person. That the average person feels the system is not working for me. And I think that it's that protest vote that we are seeing in country after country across the developed world.
But what we saw in that chart was that it's not happening in developing countries. So walk us through why. I mean, if it is a result of capitalism, how does that make sense?
Well, I think that in the developing countries, one, that the prospects for the average person have been better because economic growth in general has been better. And the second thing, which I've seen in places like India, where I travel and stuff, is that due to digitization and other technological advances, what you're seeing now is that people are being able to get welfare benefits much more efficiently, which is through bank transfers and other things. So there's a lot more benefit of technology that's spreading there. Whereas in the developed world, I feel that what's happened is that the benefits have really been flowing to the rich. So one of the data that I cited in one of my previous columns is quite remarkable, that we have the widest gap ever in terms of the income distribution and wealth distribution that we know, where in places like in America, the top 20% control 40% of the income, and the bottom 40% only control 20%. Right? So that's a massive gap. So capitalism has not been working for the average American or the average person in the developed world. In the developing world, we are still seeing some benefits flow through, particularly with greater technology, welfareism, which is becoming more efficient, and the anger at the institutions isn't as deep as now what's there in the developed world.
But then how do you fix that? I mean, let's just stay here in the U.S. for a second. I mean, can you fix that from the White House in 4 years? Can you fix that with an administration that is run by a billionaire and stocked with several other billionaires?
Yeah, so I think that in terms of that way, I think it's quite telling that if you really want to fix it, then you need to disrupt what's going on. In that regard, people see Trump as a disruptor. But I just hope he doesn't sort of fall in the trap of, what I think previous administrations have done, which is looking at the stock market every day and thinking that you get validation from, if stock prices go up, things must be okay. If stock prices go down, things aren't working that well. I think that's just not the way to go about it. That you need disruption, but you also need policies which are more focused for the average person. Like, for example, one thing which I've also written in the past is that making homes affordable again. That's just, that's something we don't focus enough on. There's so much focus on the price of eggs going up or whatever consumer staples prices going up. True. But I think for the average person, what really matters today is that they cannot afford to buy a home. more than half the Americans in their 20s now are living in with their parents because home prices have become so unaffordable, and that's such a major aspirational goal, is to own your own home. So I think you need policies much more focused on those aspects.
Does that need to be at the federal level, though, specifically on home ownership? And I actually was just doing some reporting recently in a couple of very high-cost areas, including in Nevada and in Vancouver, Canada, just across the border. Most of the solutions there are much more local. And they seem to be effective, at least on the surface. So I'm wondering, are we going to see more success at the local level in dealing with these issues than at the federal level coming out of the White House and Congress?
Well, it has to be like a combination. At the federal level, you can create policies which incentivize the local governments to do more in terms of that. But I think it's a series of policies. Some of the policy solutions that I've spoken about is, apart from making homes affordable again, no bailouts, right? This culture of bailouts, I think, really irritates the average Americans a lot. And then they're speaking about deregulation. I think that's great. I think that if you seriously do deregulation, that will help, because what's really stifling small and mid-sized business confidence in the country today is just the regulatory burden. If you just look at the regulatory cost that the Biden administration in particular put on small and mid-sized businesses, it's been enormous, and that is very advantageous to the big companies. The big companies are able to navigate regulations, they're able to afford the cost of regulations, but why is business confidence of small and mid-sized businesses today so low? The lowest it's been outside of a recession, when in fact you have economic growth at the headline level, which looks pretty good at 2.5%. I think it's policies which, that how do you sort of focus on the quality of growth rather than just the headline economic growth, which gets captured in the stock market or in the headline GDP numbers. I think that focus needs to come much more.
So based on all of this, it seems like I want to sell the U.S. and buy EM. Like, is that my rudimentary takeaway here?
Well, I think that that's a different argument, because I think what's happened here is the fact that the American stock market has become this incredible beast. In fact, the valuation of the American stock market today compared to the rest of the world is the highest it's been in recorded history. And the valuation of emerging markets relative to the U.S. today is the lowest it's been since the Asian financial crisis of October 1998. So it's this incredible dichotomy where you get a massive amount of churn, and dissatisfaction at the average level in the US and other developed countries. But when it comes to the stock market, the only country in the world where people seem to be willing to invest is the US. So you have this very bizarre situation where the American stock market today, if you look at it in the global MSCI indices and stuff, it's approaching 70%. And all the capital is flowing into one country.
But there's a reason for that, Ruchir. I mean, where else are you going to go and find this concentration of high-quality companies, innovative companies, a reserve currency? And despite all that's gone on in the U.S., we are still, at least for now, a relatively stable democracy.
Yes, so in terms of, but that's true, but what's the price you're willing to pay for it? So this has been true for the last 50 years, if not 100 years. But today, the price you're willing to pay for it is far higher than you've paid for that anything in the past. And every hero has a fatal flaw. And I think the fatal flaw here is that a lot of this growth, which appears great at the surface, is being financed by an incredibly large deficit. The fact that you're running a 6% budget deficit in the middle of an economic recovery, next year it's going to go to 7% if the Trump tax cuts are extended, that is, I think, artificially also keeping growth very elevated. If any emerging market today were to run a budget deficit of that kind, in terms of that, you'd have a currency crisis.
But we're the United States. They'll say we have a reserve currency. People were saying this when we were at 3%, we're at 4%, at 5%. I'm not saying there's never a breaking point, but there are a lot of people that will look, there's a very long runway here. I'm not saying we should be playing chicken with it.
But I think that we're getting to the end of the runway, because now we're running 7%. Our debt to GDP now has become the third highest in the developed world. If we run at this pace, by the end of the decade, we would have overtaken even Italy to become the second highest after Japan. So there are sort of, in terms of, it is this kind of complacency which I'm concerned about. Which is, in the past, America ran budget deficits, but it was in line with what other countries were running. Today, we are a huge outlier in the last 3 to 4 years. Before that, we were not. So now you can say that because we have all the benefits in the world, like a reserve currency, then why not run a deficit of 8, 9, 10% of GDP? Why stop at 7?
That's a good point. Ruchir, we have to leave it there. We're out of time. Ruchir Sharma, chairman of Rockefeller International, founder of Breakout Capital, and of course the author of What Went Wrong with Capitalism. Stick with us. A lot more coming up here on The Close, including a markdown for Macy's. This is Bloomberg. All right, time now for our stock of the hour. Taking a look at shares of Macy's, at one point down more than 5% on the day after saying it was delaying its third quarter earnings release that was supposed to come out tomorrow. This after an investigation revealed an employee hid more than $100 million of expenses. Abigail Doolittle joining us right now to talk a little bit more about this. And I did talk with the company a little bit earlier, said the employee is no longer there. They're doing a fuller investigation, but they think that roughly $130 to $150 million in hidden expenses. They did not clarify exactly what that meant, but that was the long and short of it.
It is really a wild story. How does an employee hide expenses? Where did that money go? And that the fact that it is up to $154 million and that it started in 2021. I mean, one of the biggest points here is, as you know, they found out about this in their investigation as they were preparing for the third quarter earnings report. But it's been going on since 2021. What's going on with their auditor, KPMG? I mean, how has KPMG not picked up on this before? Now, they are also saying the reason the stock is not plunging is because it probably does not signal larger accounting issues. And they're also saying it does not affect their cash management practices, and vendors have not missed payments. On the other hand,
and the amount too is a small percentage of their total expenses that they had over that period.
Right, that's a good point.
4.6 billion, and we're talking 100-something million. Not to say that missing 150 million isn't a big deal, but it's not enough to really affect the bottom line.
Right, and then but do they have to restate earnings or anything? But like you said, maybe on the margin. Here's my question. But you're looking at the actual growth of sales, and I know we had to wait for earnings, but like Blue Mercury is doing pretty well.
Yeah,
like Bloomingdale's doing pretty well.
Did well too.
Yeah, so
that would help for me, by the way. But go ahead.
Bloomingdale's up more than 3%. Blue Mercury up more than 3%. And Macy's, while they were down, their same store sales comps down 1.3%. One analyst was saying they were expecting it to be down 1.7%. So it's actually maybe better than feared. That could be another reason why the stock is only down 2%.
And one interesting thing about the Macy's branded stores is Tony Spring, the relatively new CEO, was really set out on this mission to remake those stores. He has this program called First 50, where they took these sort of mall-based stores and basically tried to modernize them, making them sort of a little bit more updated for the era. Those stores, if you just take those 50, they had 1.9% comp sales growth.
That's a great piece of color, because his plan is to close down those stores that are underperforming, and then for the stores that are overperforming or outperforming or doing well, to more sales volume.
All right, Abigail, thanks a lot. Really appreciate it. Bloomberg's Abigail Doolittle joining us there. We are 15 minutes away from the closing bell on this Monday. Ed Clissold over at Ned Davis Research will be joining us. This is Bloomberg.
So I think all in all, we are in a good place for the U.S. economy to continue doing well and for the markets to continue to do well here. But I should also just mention that big institutional investors are reducing allocations to equities a little bit just to rebalance because, the markets have done so well.
Afsaneh Beschloss there over at RockCreek, kicking us off to the close just about 50 minutes ago. Romaine Bostick alongside Alex Steele. Green across the screen, but most of that, Alex, tilted. And green also on your dress. Most of that tilted, though, to the small cap space.
Doesn't look like we're going to make that 52 record closing high for the S&P for this year. They're not going to make it, but we are seeing record highs in consumer discretionary stocks, the Russell, also mid caps, also the Dow, by the way, in case you're keeping track, because financials are doing so well.
It's like the it girl on Wall Street right now. Up 0.9%. Dow Transport's up more than 2%. And what is this telling you? Is this just people buying the beaten down stocks and saying this stuff was undervalued and bidding up, or is this real optimism about where the economy and the
feels like
going?
It has to be a cyclical trade too, because you take a look at 52-week highs, and a lot of them are financials, whether you're looking at regionals or you're looking at some of the big banks. And that feels like that's a lower rate potentially, but also just a stronger economy scenario.
Absolutely. KBW Bank Index up 1%. You're also seeing a bid come back into healthcare stocks after last week. They got rattled by the RFK stuff. NASDAQ Biotech's up about 1.5% on the day. As we move closer to the closing bells with just a little bit more than 8 minutes to go. Let's bring Ed Clissold into the conversation. He's the chief U.S. strategist over at Ned Davis Research. On a day, Ed, where a lot of people are looking at the green on the screen, they're upping their price targets, not only for next year, but even for the end of this year. Animal spirits, bullishness, Ed, are you among them?
Yeah, we are. We have been for the better part of 2 years. And the reason that we are maintaining our bullish outlook is that the thesis, the main drivers of the bull market are still there. We have disinflation, inflation rate continues to fall. Earnings acceleration, quarter after quarter. S&P 500 earnings growth has been faster than a year ago. And then finally, the market advance is fairly broad. It has in most of the year. 75% of stocks are above their 200-day moving averages. So if most stocks are going up, that's telling you it's a pretty broad advance. So we'll maintain that until those drivers go away.
I'm curious about the disconnect, though, in the way people are viewing this. We're coming out of an earnings season that by pretty much most reasonable measures is good. And let's face it, the earnings season's pretty much over at this point. Yet when you look at the earnings momentum indicators, particularly in the analyst community, the sell-side analyst community, they're actually revising their estimates for aggregate earnings on the S&P down for next year at a time where I think some of those estimates should be going up, particularly out of what we just learned out of this past earnings season.
I think this is when the starting point really matters. For the first half of 2024, the estimates were pretty low. The second half, they've ratcheted up. So, for example, in Q3, we've seen the beat rate of percentage of companies that exceed expectations come down slightly just because the hurdle is higher. And the hurdle for 2025 is actually pretty high, too. With our data, the consensus estimates for the S&P 500 are around 16% for next year. That seems pretty lofty, so I wouldn't be surprised if those numbers come down. And, if they can bring them down while the market's still going up and other drivers are there, that's actually a bullish thing. You don't want the analyst community to turn negative, just say when the macro front looks more difficult as well. So I'd say let's get those bad earnings revisions out of the way now.
So if you're still maintaining that bullish outlook, though, does that include an easy win by, say, value?
Well, this is where the earnings story gets pretty interesting. The big drivers for most of the last 2 years have been the Mag 7 stocks. They just produced fantastic earnings growth, well above the rest of the market. In fact, the other 493 stocks in aggregate have barely turned positive in their earnings growth. And just the law of large numbers are going to probably work against the Mag 7 next year. Now, it's not a monolith, but as a group, they're going to have a slower earnings growth. So you could see the other parts of the market actually catch up. And so that's why I think one of the reasons why we can get this rotation. The other one is that we could get higher nominal GDP growth, a combination of a decent economy and a little bit higher inflation next year. And so that would favor small caps and value stocks as well.
All right, let's continue the conversation that Romain and I were just talking about when it comes to financials, because they've really outperformed since the election. And you have a bunch of them hitting 52-week highs today, whether you're looking at regionals or the big guys. Is there more juice in that trade?
We do think so. We upgraded financials a few weeks ago, so that's one of our favorite sectors. What we're watching closely is the yield curve. The yield curve steepened, but it's kind of stopped steepening here, and so that's going to need to continue to happen. If you look at what happened in 2016, actually financials did well then too, right after the election on kind of economic optimism. So yeah, there's lots of reasons to like financials, but if you want to think of one thing to keep an eye on, is make sure that yield curve doesn't reinvert.
Oh, okay. Let's talk about yield. Since you brought it up, Ed, I mean, when you look at the drop in yields today, and more importantly, just the oscillation that we've seen. Of course, at one point you had the big sell-off, and then it kind of paused, and now you're seeing a bit of buying in the space. And of course, no one seems to know exactly what the Fed is going to do next. No one quite knows whether the economy is going to be ripe for rate cuts or maybe even rate hikes here. How do you sort of model in where interest rates are going, and more importantly, the shape of that curve?
So our expectations is that the Fed's going to move slowly, probably cut again in December, maybe go to every other meeting the first half of next year. Then things get pretty interesting, Romain, because at that point, you could get pretty close to what the Fed's target would be. If inflation moves back towards, say, between 2.75 and 3%, then you'll be at a real Fed's fund rate, which has been pretty much at their target. So they may be close to either done or, if not, a long pause once we get to mid-year, and at that point, then we'll have to look at inflation expectations to see if the long end of the curve can remain above the short end, hence the normal shaping yield curve.
All right, Ed, gonna leave it there. Ed Clissold, he's the chief U.S. strategist over at Ned Davis Research, counting us down to the closing bells here on this Monday afternoon. And Alex, I do want to go back to a point that you were making about financials and the 52-week highs. So I was just crunching the numbers on the Bloomberg terminal. 24 stocks in the KBW Bank Index, 23 of them right now are trading at 52-week highs.
And that's with a lower yield, and that's with a curve that has now completely flattened.
Yeah, and it's kind of interesting, too. I mean, we talk about what people are buying, or more importantly, why they're buying it here. And maybe this is a little bit more divorced from whatever the Fed is doing. Maybe it's a little bit more divorced from what the economy is doing. We talked a lot this year about how this was an idiosyncratic market. People are picking and choosing, and there's a lot to pick and choose from in the financial space.
It's true. Also, you have to wonder as well, when you have a holiday shortened trading week, we're nearing the end of the year, and that was really what Scott Rubner at Goldman Sachs was saying, like you get a year-end rally kind of starting right now. You're just going to see a lot of not book squaring, book fanfare, highlighting.
I don't know what you're trying to say.
Make your portfolio look fancy.
But I love the comment he said. Nobody's showing up on Friday morning after Thanksgiving and selling was kind of what he said.
Yes.
More or less. We'll see what happens. Obviously.
Window dressing. Sorry. Go ahead.
All right, no window dressing here on the close. As we move closer to those closing bells, a full breakdown of all of today's market action and then some. That coverage, it starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele, taking you through the closing bell. A global simulcast. It starts right now. Scarlet Fu joining us in the TV studio. Carol Masser and Tim Stenovic in the radio booth as we welcome our audiences across all of our Bloomberg platforms here on this Monday afternoon. Big outperformance today, Carol, by the small and mid-cap stocks versus the large.
Yeah, interesting. I got to say, though, I've been looking at the Treasury curve and just seeing yields back down again. Some optimism over the nominee for U.S. Treasury Secretary. Just reminds me how sensitive this market is going to be with all the twists and turns potentially of the upcoming administration.
You guys are watching stocks and treasuries. I'm still waiting for Bitcoin to hit 100,000. So close.
So close.
You have balloons ready? You ready to go?
No.
Hats and everything.
If you had a balloon, you'd have to keep changing the number on the balloon. That's the problem.
Within $300 of hitting $100,000 just a few days ago, down to 95,000.
Yeah, well, I mean, give it a few minutes and it could all change, right? My question about the bond market, kind of celebrating Scott Bessent's nomination, is that he was chosen in part because of his commitment to tariffs, which is seen as inflationary. So it's a little bit of a head scratcher. And I talked to Priya Misra of JPMorgan earlier, and she said what the bond market is really focused on is his commitment to tackle the deficit and to tackle deficit spending.
Or this could just all be positioning headed into a shortened holiday trading week and towards the end of the year as well. That U.S. exceptionalism theme, though, clearly continuing throughout all areas of the market.
Yeah, we talk about another day higher for the market, and more importantly, another day where we see the large caps taking the back seat to the smaller and more cyclical parts of this market. That's the broadening that a lot of folks wanted to see, and at least for right now, they get it. Scott Rubner over at Goldman Sachs saying this is the start of a year-end rally. 1% higher today on the Dow Jones Industrial Average, 0.3% higher on the S&P 500, 3% higher on the NASDAQ Composite, 1.5% higher on the Russell 2000. S&P mid-caps up 1.5%. And Carol, Dow Transport's going to close out the day higher by 2.2%.
All right, good to know. S&P 500 overall, remain breaking down those big numbers. You had most names in the S&P 500 higher, 386 to the upside, Scarlett, 115 to the downside, 2 unchanged.
Yeah, and that's reflected in the sector breakdown as well. You've got REITs, consumer discretionary, and materials all up about 1% or more. The weak links in today's market, the biggest sector in the S&P 500, tech losing about 1/3 of 1%, and energy down about 2% on the day.
All right.
And can I just point out, too, before you go, just going back to a conversation Alex and I were having on TV, at least 105 S&P names today hit 52-week highs.
Interesting. All right. Well, here's a name that definitely popped up.
That's 20% of the index, Carol.
Hey, some mansplaining on the percentage. I really appreciate that.
That's journalist math.
Love it.
All right. Here's the number one gainer in the S&P 500, the NASDAQ 100, guys. Supermicro Computer up another 16% in today's session. It was up 80% in the last week. That was the largest weekly gain on record. But we know since the company has submitted that plan to remain listed on the NASDAQ, naming a new auditor, they have have definitely had a lot of upside momentum, but keep in mind, still off about 70% from a record that they set back in March. All right, off to another gainer, up 6%. What? Are you good?
Yeah.
Okay.
Keep going.
All right. Thank you very much. Yeah. Moderna up about 6%. This was an outperformer in the NASDAQ 100. Remember on Friday, company management said RFK's nomination to the Department of Health and Human Services unlikely to mean that you'll see the removal of vaccines. They said this at a Jefferies fireside chat. Stock has rallied 22% in the past 3 days, still down more than 50% year to date. 10% of the float shorted.
But was there an actual fire?
What?
Yeah.
What do you mean?
I don't know.
What are you talking about?
Nothing.
All right.
I love it when Carol forgets to ignore me.
I know. It's like, all right, company's going to be presenting at a bunch of healthcare conferences in December. All right, I got one more. I'm going to try and get through it. AMC Entertainment. Did anybody go to the movies this weekend?
No.
No, Wicked and Gladiator. Did you see one?
Wicked. I did neither. Okay. AMC Entertainment, though, I was pretty happy to see people back at the theaters, and so you saw popping that one up about 7%. Tim's getting ready to take his kids, though, to some movies. Are you thinking about it, right?
Moana 2, man. Come on,
yeah,
right?
that's going to happen.
Yeah,
that's a birthday party. That's a drop-off birthday party. We're excited about that one. Tesla shares falling today by 4%. Look at that. This is interesting. After Bloomberg News reported that Governor Gavin Newsom of California, he unveiled plans to offer state incentives to EV buyers if President-elect Donald Trump repeals that federal subsidy after he takes office next year. And he said Teslas would be excluded from such rebates. The idea is that this would spur greater competition. So the governor's office told Bloomberg News that the proposal includes market share limitations, and those limitations would exclude Tesla from those credit. Shares were pretty steady during the day, but then fell late in the session, finished down 4%. Macy's shares fell 2.2% today. This after the company said it would delay its third quarter earnings release after an investigation revealed an employee hid more than $100 million of expenses. We do expect Macy's to come out with those numbers by December 11th. We'll wait and see if they release more information about this employee, quote, intentionally making erroneous accounting accrual entries tied to $132 to $154 million of cumulative delivery expenses stretching over multiple years. The company said this earlier today. Once again, shares down a little more than 2%. And look at this one. Cava Sciences fell 84% today. It's the largest decline on record for the company since it went public back in the year 2000. The company said its Alzheimer's treatment did not show a significant reduction in cognitive or functional decline versus placebo in patients with mild to moderate levels of the disease. This is in a phase 3 study. Investors selling as a result today.
All right, I just want to touch on yields, guys, because this was pretty exciting in the space. You got buying across the curve, but that curve is now absolutely flat. So do we actually invert again? We also did a 2-year auction. It seemed like it was a solid bid to cover ratio, although the yield was higher than the previous auction. And we get a 5 and we get a 7-year later on this week, bringing together about $114 billion worth of Treasury supply, guys. Zoom. Let me go to Zoom. Should we go to Zoom?
Because they're still earnings?
They're earnings, and they're changing their name.
They're changing their name.
That's all we know.
They're going from Zoom video communications.
Okay.
To get this, Tim, wait for it.
Okay.
Zoom communications. So they're dropping the video.
Okay.
So I'm not sure what that means.
They
Are
don't
they
want to
getting out
limit
of video?
themselves. No, they don't want to limit themselves. Optionality.
Is that because everybody turns off the video when they're doing the meetings?
I don't do that. You do that?
No, we're not allowed to do that here. This is
Younger
other
people do
companies.
that. That's a Gen Z thing.
I do it.
Yeah.
Don't you do
Oh, yeah,
it?
I didn't know
Gen
you're
Z.
really there.
Gen Z does it.
Sometimes I'm in my pajamas. I don't want anybody to know what I'm in.
Okay, while we wait for Zoom.
Can we talk private colleges?
Yeah,
'Cause,
let's talk a little bit about some
Black
private schools.
Friday is coming. Things will be on sale. But right now, Tim, there's some private
Tuition?
colleges, tuition on sale.
Yeah,
on
so
sale? Wait, on sale.
I mean,
like,
wow.
don't get your hopes
All right.
up.
It's
Don't get
kind
your
of a
hopes up.
haircut.
There's sort of 2 tiers of what's happening here, okay? So you got a college out in Minnesota, Bethel University. It's about $44,000 a year. Next year, they're going to only charge about $26,000. It's one of a dozen across the U.S. They're going to slash prices in an effort to bring in more students. Supply and demand, folks.
That's good. How much was it? How much was college when you went, Scarlett?
$20,000 a year.
20,000. How much?
16?
Yeah.
But it was much lower, and then it re-rated to 16.
I'm older than you, so I was even lower than that. So, yeah.
Now it's almost 100,000.
I guess that's a bargain. I mean, look. I mean, I guess you're saving, quote unquote, whatever, the 20 grand or whatever for this particular college. But at some point, you need the bigger colleges to get in on this. Otherwise, you're not really going to see much of the needle moved.
All right, let's go to Zoom, guys, because the earnings are out. It's
Which is
changing its
Zoom
name.
or Zoom Video?
It's Zoom Communications, previously known as Zoom Video. Taking a look here at, let's see, fourth quarter earnings coming in. The range is 129 to 130. That's a little better than estimated. Their revenue forecast for the fourth quarter on the high end, 1.18 billion. That's a little better than estimated as well. And the stock, though, down about 6% on that.
In terms of full year outlook, Zoom Video or Zoom Communications now sees revenue from 4.66 billion. Well, I don't actually have the range, and now it sees 4.63 to 4.64. So we're talking about a really narrow range here.
Yeah, and this was the big question, of course, during the pandemic was how did they sustain that growth? Remember, they were growing something like 300% in 2021, also triple digits, I think, in 2022. And now we're talking about
a utility
2 to 3% growth.
Yeah.
And it's sort of like, well, what's the longer term story? And this is a young company, so it's not like, this is some mature company. They can't find a way to grow. Where's the growth coming from?
I'm still wondering about this name change. Zoom Video to Zoom Communications. Is it because of AI? Here's what Eric Yuan said. A quote, at Zoomtopia, we announced Zoomtopia. Major milestones such as AI Companion 2.0 and paid add-ons for AI Companion and industry-specific AI customization.
What does that mean?
Further cementing our vision to deliver a differentiated AI-first network platform. It's about AI.
When
Why didn't they just
Zuckerberg
include
pivoted
AI
to the
in the name?
metaverse or something like that?
Here's a good headline. Zoom boosting its buyback by $1.2 billion. Yeah. So we'll see.
Yeah. Can I squeeze in another earnings? Leslie's, which makes pool equipment, ultimate discretionary spend, down 15% in after-hours trade. Big miss on a couple key metrics, including on EPS.
If only you had bought made a pool.
I tried to, but
no one wants a pool. They already got their pool. They're done.
The condo board, was kind of.
They were not on board.
They frowned on that for the lobby.
Yeah, I don't know. You know how hard it was just to get a washer dryer in the.
Yes, I do.
All right, guys, that is a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals Monday almost over. We will see you again, same time, same place tomorrow.
Stick with us. A lot more coverage coming up here on this Monday, or Merger Monday, with deal makers striking roughly $35 billion worth of transactions today alone, signaling a big finish to the year for M&A. Who better to talk about that with than Doug Braunstein, Vice Chairman over at Wells Fargo. That's coming up next. This is The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. Another day of outperformance for small caps relative to the large. Take a look at the Russell 2000 and the big gain that we saw on the day, 1.5%, fifth straight day now that we've seen the Russell outperform the S&P, outperform the NASDAQ. That is the broadening, the cyclical rotation that a lot of people were hoping for. It is not just combined to the Russell. Dow Transport's up more than 2% on the day. S&P 400 mid-caps up about 1.5%, despite the fact that you had a massive drop in yields, down 14 basis points on that 10-year, 4.2 and change right now. Remember, we were flirting with 5 just a few weeks ago.
Yeah, and so much for 4.5%, 5%. By the way, Russell 2000 record high.
Record high, absolutely.
So, ding, ding, ding. All right, let's take a look at some big cap movers. We're going to start with Macy's, falling as much as 5.1%, delaying its third quarter earnings report. An internal probe found an employee hid more than $100 million of expenses over many years. So it's going to delay its earnings report and outlook until by December 11th. The biotech firm Cava Sciences dropping 84%, the most on record. Data from its Alzheimer's treatment disappointed. It's now reviewing all the data and will evaluate next steps. Meantime, Hims rising the most ever. It's become part of the Trump trade on a report from a short-selling hedge fund that Trump's pick to run the FDA may be a key ally for the company. How? Marty Makary is an executive at Sesame, which also sells compounded GLP-1 drugs online, just like Hims.
Yeah, I mean, I'm surprised at the turnaround, but it gets to this idea that no one really knows anything right now. Also, I just want to provide a quick clarification. Yeah. We did actually fall just a couple of points shy of the record high on the Russell, but we're almost there, Scarlett.
So close.
Hold your breath. Maybe tomorrow.
I've been waiting.
Yeah,
all right, maybe we'll get there tomorrow. Yeah. As we've been reporting, the Trump trade has been an absolute boon for the stock market, the dollar, and Bitcoin. And these moves are reshaping the investment landscape as Donald Trump returns to the White House in January with a pro-growth agenda. Certain industries seen as beneficiaries, like banks, which are up just over 14% since Election Day. I'm pleased to now welcome Doug Braunstein, Vice Chairman of Wells Fargo, former CFO of JPMorgan Chase. Doug joined Wells Fargo in February with a mandate to expand the bank's corporate finance and advisory business. Good to see you.
Great to see you, Scarlett. Romaine, great to be here. Thank you.
So as Romain mentioned earlier, today is Merger Monday. $35 billion of deals announced across different sectors, including one that Wells advised on. QuickREIT buying Summit Materials for $11.5 billion. Last week, Wells advised on Berry buying Amcor. To what extent are these deals emblematic of what we might expect to see in the months ahead?
So, Scarlett, it's a great question. And I think in your opening, you covered a number of the factors, quite frankly, that I think are going to drive M&A activity both today and going forward into 2025. And it really amounts to the factors that create confidence for CEOs. And there's really four key ones here. The first is the underlying economic environment. It feels increasingly comfortable to folks that we've had a soft landing. There's an expectation that we will have a positive GDP for 2025 and going forward. The second is the robust support in the capital markets. The debt markets, which we can talk about in a little bit more detail, are wide open. We've actually had a number of those capital markets with record issuance in 2024, and credit spreads are at or near, for many of these categories, multi-year tights. The third piece is the stock market. You've got sellers in the public markets where their stock prices actually performed really well. And in particular, the small and mid-cap names in the Russell, Romain, that you talked about, those comprise a lot of sellers in the market. And when you're selling at or near your 52-week high, it's a much easier discussion in the boardroom. And then finally, the buyers, with that, their own stock prices at strong performance and this access to capital, that makes for a very potent M&A combination.
Yeah, that's quite the cocktail. So I mentioned that you joined Wells Fargo in February with this mandate to focus on expanding the investment bank operations. There's a lot of excitement about M&A and IPOs picking up. How does this influence your plans when it comes to hiring for this build out of the investment bank? Yeah,
so Scarlett, actually, you also mentioned, in the last 2 weeks, Wells has announced two $10 billion plus transactions, one advising on the sell side, which was Berry, one advising on the buy side, QuickREIT today. Those are, I think, representative of some of the investments that Wells has already made. So over the course of the last 24 months, we've already hired over 60 managing directors across our M&A business, our equity and debt capital markets, and our coverage businesses. And as you know, when bankers join, it takes them time to understand the systems of our big institution and to re-cement those relationships with their clients. We expect to continue to invest over the course of 2025 in more coverage efforts. And you're just beginning, I think, in the last 2 weeks to see the benefits of those investments we've made. And I think our expectation is we need to be ready as a firm to take advantage of what our clients are going to need, which is advice and capital to do deals in 2025.
So is the desire, though, to do these bigger deals like what we're seeing with QuickREIT, the billion-dollar deals, or more into the middle market areas that has really been kind of the sweet spot for Wells for a while?
Yeah, so Romain, it's actually, it's a great question. You want to do both in order to be a leading franchise. And one of the things that's really attractive, that attracted me to Wells, is Wells has a deep, strong relationship base with companies across the middle market, through the commercial bank, and through the wholesale, their corporate investment bank, the larger companies. And in order to have, over time, a world-class both M&A and capital markets practice, you need to do both. You need to have a strong presence in the middle market, mostly to sell companies, and you need a strong presence in the larger cap, hopefully to advise on buying and on financing.
Why don't you think we saw that before? Because there has been criticism that Wells didn't have a big presence, at least in the top end of the market. But there was also criticism that with the middle market companies, that they weren't, that as those companies grew into bigger companies, that they would then leave for, JPMorgan or one of the other bigger banks.
Yeah, well, again, I'm 8 months into the job and couldn't be happier. The company itself, right? Charlie Scharf came in 5 years ago, has built a whole new management team. We've, as I mentioned, added significant talent across the bank. And I think really...
Are you having trouble getting that talent specifically for those roles?
No, we're not actually.
Okay.
I think it's, and in part because when people from the outside look at the platform, we have this very long-standing, deep and wide relationship base with small, mid, and large cap companies. And what we're adding is that capability and expertise to execute for them, not only in their commercial banking product needs, but across the entire spectrum of investment banking. And so I think, Romaine, you're just beginning to see what has been a relatively recent investment start to pay off, and but it will take, relationship building, investment banking capabilities. Those products take time, and we are absolutely committed to take the time and make the investments necessary to be successful.
What are your thoughts on the overall hiring environment right now for those senior bankers? How does it look to you?
It's a good time to be a very high quality banker because I think there's a scarcity of those individuals in the marketplace. The good news is we think our franchise and the platform and the opportunity set for people who are looking over the next 5 to 10 to 20 years and really want to have an impact on the business that they help bring in. I think we're a great platform. And as I said, we've already attracted a very large number of senior professionals.
So I'm glad that Romaine touched on the middle market relationships you have with middle market clients. Other firms with large commercial banks like Bank of America or JPMorgan are trying to tap those kinds of businesses for fees as well. It's very lucrative, obviously, and Goldman Sachs has also been pretty aggressive. Is this because it's just a really big opportunity, Doug, or is this a reflection of how competitive it's become, or even hyper-competitive?
So, Scarlett, there are really only 3 banks in the U.S. that have a sort of a national commercial bank footprint, and you mentioned 2 of them. Wells is the 3rd. Those relationships go back for many of these companies. We provided them their first loan, so they are long and they're deep. That part of the market is an incredibly important part of the wallet share for all of the corporate finance products. So if you want to be a leading player, you have to compete in that segment of the market. And for us, it's a place we've had long-standing relationships, and we're now beginning to bring to those relationships that world-class execution capability. So every part of the market, large and small, is competitive, but we think we have some unique relationship capabilities and advantages that hopefully will allow us to move quickly in that arena.
Doug, I have to ask you about what's going on in Washington, particularly with the new administration coming in. What's your relationship like right now with folks in Washington? And B, do you think there's going to be a material change in the approach that regulators have taken, not just with the banking sector overall, but specifically with Wells Fargo?
Yeah, so as I talked about the M&A marketplace, I would say the underlying backdrop for fundamentals are really strong. You now add to that what the market believes to be 2 things reflected in the new administration. One is the fact that there's going to be a decrease in the regulatory burden, both for industries on the whole and as it relates to the FTC. Right? And so that removes, quite frankly, a significant concern and impediment for a number of CEOs that have deferred their action. The second thing is that the market clearly believes that this will be a pro-growth agenda on balance, again, giving confidence to CEOs. So when you look at both the market trading levels today, as well as the underlying growth in M&A transactions and the growing backlog, I think that reflects a reasonably high degree of confidence that this administration is going to be supportive of that activity.
Do you have a high degree of confidence that Wells Fargo is going to be able to grow with that? I.e., is that asset cap going to still be there? Because you're talking about a lot of opportunities, but as I'm sure you know, there is a constraint to just how much you can take advantage of those right now.
I would leave, we have a lot of public statements on that. I'm going to leave the specifics of those comments to Charlie and Mike. What I would say is that since I've been at the company, in every decision that we make, we place the importance of prudence and responsible decision making at the very heart of how we address the needs of our clients. And so I'm confident that we're going to be able to prosper in the environment going forward.
So, Doug, we started with M&A. I kind of want to go back to M&A, come full circle. Obviously, that feeds into other things like debt financing, like equity financing as well. To what extent do you plan to use M&A as an in to those other fee-generating businesses? Yeah, so,
Scarlett, the M&A business in many ways drives some of the most important and, quite frankly, most profitable parts of the capital markets business. So, today, for example, we announced a buy-side transaction where we are helping that company to do the financing, as you've reported. And that's a really important part of what we believe we bring as capabilities, whether that's debt or equity financing, to our partners. And as one of the country's largest banks, we have a significant amount of capacity to help facilitate those transactions. On the equity side, both as a financing matter for our customers, as well as an alternative exit for parties who are thinking about monetizing their investment, the opening up of the equity capital markets, there's been an increase in IPO volume this year of almost 50% over last year. We're still below 10-year trends. But again, we think the opportunity set for our customers, particularly in the commercial bank, to tap those markets is going to be a significant factor into 2025.
Doug, such a pleasure to have you on. Thank you so much. Doug Braunstein is vice chairman at Wells Fargo, also a proud alum of Cornell. Go Big Red this weekend.
Go Big Red.
You had to squeeze that in.
I did, yeah.
Thank you. Thanks.
Take care. All right, let's move on to the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Tim Cook, the Apple CEO, joining more than 20 corporate leaders in discussions with China's premier on trade. I'm always tempted to call him Tim Apple because that's what Trump called him.
That's become such a joke and such a meme. But you know what? He deserves a lot of credit for how he navigated the first Trump administration. Remember, a lot of people thought Apple was going to be behind the eight ball. But I don't know exactly what he did or said, but he certainly managed to navigate the company through it. There's a reason why he's considered to be one of the best corporate CEOs.
Yeah, he got the carve out from the tariffs. So.
Absolutely. And of course, one of the best investors out there is who I'm keeping an eye on, Warren Buffett, 94 years old, and he's donating, over $1 billion in shares of Berkshire to charities. This is part of that big charitable pledge that he made about 2 decades ago to effectively give away almost all of his fortune here. It's kind of a hodgepodge of the charities that he's given it to here, but kind of fits with what he's been talking about, basically putting his money where its mouth is.
Absolutely. Back in 2010, he signed the giving pledge with the Gates, Bill and Melinda Gates.
Yeah.
Buffett, by the way, worth more than $150 billion, seventh richest person, according to the Bloomberg Billionaires Index.
All right. Well,
must
good
be nice.
for him. Yep.
All right. Third on the docket is Adele. The British singer played her 100th and final show of her 2-year residency in Las Vegas. 2 years is a long time. She got emotional and said that she's sad it's over, but was happy that it happened in September. And I guess this is no surprise given it was a 2-year set. She suggested she was exhausted from the run of shows, and now she plans to just rest, take an extended break, so she can live her life.
Well, good for her. She's made a ton of money. I'm sure she'll be back in a couple of years with the new music and
Inspired.
a new concert there. I tried to get her tickets to this. I was out there in January during the Super Bowl, and she was performing. And first of all, she only performed like 3 days a week, which I was like, okay, that's not really. I mean, nice work if you can get it.
So you're not impressed.
And the tickets were insanely expensive and sold out. So there you go.
That's what happened.
Anyway, Scarlett, one mover and shaker that we're going to be talking to is next. That's Brad Schulman. He's the CEO of Cava. We're going to catch up with him on the trends in the fast casual dining space. That's coming up next, right here on The Close, right here on Bloomberg. All right, let's take a look at one of the top winners in the market this year. It's Cava. Shares of the fast casual Mediterranean chain surging 225% since going public, driven in large part by its unique menu offerings and better in-office work trends. Joining us to talk a little bit more about what he's seeing at Cava and in the broader dining space is Brett Schulman. He's the co-founder and the CEO of Cava. All right, Brett, let's start off with your company, first of all. Obviously, the growth has been phenomenal. You've basically been tracking all year long at 30+% growth on a quarterly basis here, and most analysts expect that to continue at least in the high 20s to low 30s for the foreseeable future. When you talk about sustaining that growth, Brett, what do you have to do that you haven't already done to sustain that?
Well, Romain, it's great to be with you. We just have to keep executing on our strategic plan. It's really focused on our mission to bring heart, health, and humanity to food. And that's expanding our Mediterranean way in communities across the country. So our new restaurant development, it is building personal relationships with guests even as we scale. So we just launched our new loyalty program, a reimagined loyalty program. And it's running great restaurants every location, every shift. So we also recently launched a new labor scheduling and deployment model to put our team members in the right roles at the right moments in the right places to deliver those great guest experiences that's driven that exceptional traffic growth we've seen over the course of the year and especially in Q3.
The environment that we're in right now, Brett, or maybe the environment I should say we're going into 2025, is that an environment where you can envision Cava expanding its footprint significantly?
Yeah, well, we actually gave preliminary guidance after our recent earnings of at least 17% growth, unit growth, which is a bit of an uptick from 15% compound annual unit growth rate that we committed to at our IPO. And we have visibility with our real estate pipeline and our GM, our general manager talent pipeline to accelerate that growth rate a little bit next year and be able to bring our Mediterranean way to more people sooner.
And, you know, a lot of people call Cava the Mediterranean Chipotle, and they mean it in the best of ways, of course. I'm curious, when you expand Cava outlets, how are you thinking about whether it's in cities or suburbs, and how mindful are you of where Chipotle is and how far or close you want to be to a Chipotle?
Well, that's what gets us so excited, Scarlett, is that we have multiple ways to win. We see our success being very broad-based, and we commented that on our traffic comps being very broad-based, whether it was by vintage of restaurant or geographic region or the type of trade area. So whether that's Bryant Park in Manhattan or Back Bay in Boston in the urban cities, or whether it's in smaller markets like Mobile, Alabama, or our recently opened restaurant in Merriam, Kansas, when you look at the top decile of our restaurants, it's not one type of geography or trade area. It's everything from a college-adjacent site to an ex-urban small town, freestanding building with a pickup by car digital drive-through lane, or an end cap location in a suburban anchored shopping center, or an urban location that plays off the office worker as well as some urban residential. So that just speaks to the broad appeal of our Mediterranean cuisine, where we're able to meet the needs of so many different consumers.
And, you know, Mediterranean is part of your brand. How do you go about innovating on Mediterranean cuisine? How often are you introducing new items versus kind of removing or streamlining the menu?
Yeah, I think that's the beauty of our operating model. It's 38 to 40 items on the serving line that leads to about 17.4 billion combinations. And we want to keep that newness and that excitement to guests without overcomplicating our operations. And I think a great example of that this year, we launched a new main protein in our steak, as well as a flavor innovation on our fan favorite pita chip. So a new garlic ranch pita chip that was really well received in October. And one of my co-founders, my partner, Ted Zeno Christos, is our chief concept officer. And he's working with our excellent culinary team to build a multi-year pipeline of that exciting innovation of culinary through our Mediterranean lens to bring to our guests each quarter and each year.
I am curious, when you start to talk about kind of all the things you want to do, kind of what Cava is as a brand, as an identity for a lot of your customers, I do worry about costs, ingredient costs, labor costs, all the things that go into running a restaurant. And I know this is kind of the old question that every restaurant CEO gets asked, but there's a fear that heading into next year, given some of the trends we've seen, that those costs are going to be higher. Are you preparing for that or not?
Well, we're always preparing, Romain, for higher costs, but I think what we've been able to do successfully is over time invest in robust infrastructure, whether that's our direct source supply chain. So over 85% of our ingredients we directly source from our grower rancher partners, or our vertically integrated production. So we have 2 production facilities where we produce all of our fresh crafted dips and spreads, and we're able to deliver that to our guests with quality, consistency, and cost effectiveness. And what that's led to is we've been able to expand restaurant level margins significantly over the past few years, and at the same time, reinvest in our guests, reinvest in our team members. So whether that's investing in better wages and benefits for our team or mitigating the price increases that we've had to pass along to our guests. So in 2024, we took less than 3% price. We did not take any incremental price as a result of the legislation in California, AB 1228, where all of our peers took incremental price, passing along those increased labor costs. And when you look back at the time period from 2019 to 2023, we only took in total 12% price, where CPI grew at 18%, and the Department of Labor noted that fast food grew over 30%. So we've been able to underprice inflation, pass that savings along to our guests, while at the same time expanding restaurant level margin and creating great shareholder value.
I am curious. I know the overwhelming majority of your revenue comes from the restaurants themselves, but you obviously have a line of products that can be bought in retail outlets, traditional grocery stores, if you will. Is there a move at all to try to expand the amount of revenue that you get from the retail side of it?
We're actually at 1,000 grocery outlets today across the country with our dips and spreads and some of our refrigerated dressings. We think it's a great option on the upside in the future. It's not something we're intentionally growing today. It's still a very small part of the business, but it's a really nice brand halo, and I think it speaks to our culinary credibility and where guests can interact with us and they can have their favorite Cava dip or dressing in their refrigerator at home, serving to their friends and family, especially during this upcoming Thanksgiving week, and really creates a nice brand halo that allows us that opportunity in the years to come to grow the consumer packaged goods side of the business in addition to the dynamic restaurant growth.
Brett, I got to ask you about value menus and discounts, which is what everyone in the industry is offering. McDonald's most recently with this new MIC value offering that replaces the old value meals. I know that you've talked about how you don't want to be discounting yourself to prosperity, but then how do you position the value proposition you do offer without a headline that essentially brings in more customers, brings in more foot traffic to say, hey, we've got you covered. We know how much everything costs, and we'd like to offer you something better.
Yeah, we think of value as a combination of factors. It's the quality of the food we serve and the ingredients we source. It's the relevance of our cuisine, that Mediterranean cuisine that's been ranked the #1 diet for 7 years running. It's the convenience in which you can access that cuisine. So whether that's our digital order ecosystem, pick up off the shelf, or one of our over 50 digital drive-through pickup lanes, or the way we deliver our Mediterranean hospitality and the experience you have when you come into our physical spaces and have that interactive walk the line experience. And at the end of the day, the bang for the buck you get, that great bowl of fresh Mediterranean food with our Mediterranean hospitality, has really been meeting the moment and resonating with the modern consumer.
All right, Brett, really appreciate your joining us today. Thank you so much. Brett Schulman is co-founder and CEO of Cava and remain, as we were saying, one of the hot stocks over the past year.
Yeah, absolutely. Another stock that is hot, but for all the wrong reasons right now, is Kohl's, down about 3.5% in the after-hours trade. The current CEO is out. A new CEO is in. Now, we should point out Tom Kingsbury, who was the CEO of Kohl's, or still is, but he is stepping down. We should point out he was kind of brought in on an interim basis back in 2023. This is when Michelle Gass had left the company at the end of 2022. He's 70 years old. He was named permanent CEO, but the expectation is he wasn't going to stay around for too long. We're now learning that Ashley Buchanan has been appointed as CEO starting January 15th. He has currently been running Michael's. That's, of course, the craft store controlled by Apollo now. But Kohl's right now taking a slight leg down here, maybe some confusion as to why Kingsbury is leaving and what Ashley Buchanan will bring to the table in his replacement.
And worth mentioning as well, Kohl's will be reporting quarterly results tomorrow morning before the opening bell. Its net sales are seen declining about 4.5%, extending this almost 3-year streak of declines. Let's take a look overall at what happened in equity markets and across the asset classes in general. We got within spitting distance of a record high for the Russell 2000, but didn't quite do it. So it's a 1.5% gain, just shy 2,442.742 would have been matching the record high. The S&P 500 ending up 0.3%, but the real action there was in the Treasury market. You see yields coming way down. The 10-year now at 4.27%. So long to 4.5%, 5%.
Yeah, absolutely. Here we came just about a half a point away from, of course, closing at that record high. Nevertheless, got to make up some ground tomorrow. When we come back after the break, we're going to make up some ground with a look back at this day in history. 22 years ago, when Roxio, the software company, decided it would be a good idea to revive the music file sharing company Napster. That discussion coming up after the break. This is Bloomberg. All right, time for a look back at this day in history. 22 years ago, when the software company Roxio bought the name, logo, domain, technology, and other intellectual property of notorious music sharing company Napster. Founded by Sean Fanning and Sean Parker, the peer-to-peer file sharing service relied on the relatively new coding format MP3 that allowed people to pass audio files around different devices no matter the operating system. It was a hit, reaching as many as 80 million registered users in barely 1 year of existence. Unfortunately, Fanning and Parker didn't bother themselves with the pesky parameters of copyrights and trademarks. So like Icarus flying too close to the sun, Napster's out-of-nowhere success was so vast and so fast, it couldn't last. Musicians, including Dr. Dre and Metallica, sued the company, and a lawsuit led by the Recording Industry Association of America ultimately led to an injunction that shut down the service in 2001, just about 2 years after it had launched. In 2002, November 25th, in stepped Roxio, a company that had made a name for itself selling software to burn CDs and DVDs. Now, Roxio scooped up the remaining patents, intellectual property, and the brand name of Napster for just about $5 million with the aim of expanding its role in the burgeoning digital media landscape. The experiment, though, only lasted a few years before the Napster service was sold off again, this time to Best Buy for $121 million in 2008. Now, Napster would go through quite a few other iterations, including when HiveMind scooped up the assets and said it would rebuild Napster around cryptocurrencies. And while Napster is largely considered a cautionary story, it's more of a cautionary story for the music industry itself, because almost everything Napster did 25 years ago is now standard practice today. The majority of music is bought, shared, and listened to on file sharing platforms, albeit legally. The unbundling of albums so that you can buy individual songs, standard practice. Sean Parker would later become president of Facebook and today has a net worth in the billions. But probably the biggest takeaway from Napster is characterized by the Silicon Valley ethos of move fast and break things. Napster did just that. And in 2 very short years of existence, scaled up fast enough that legacy analog record companies had to grudgingly find that they had no choice but to make peace with the digital MP3 world. Scarlett?
Turns out Napster was ahead of its time. I remember those days where you had to, if you liked a song, you had to buy the entire album and then listen to the entire album to get to the song. It was, it was one way to make sure that your other songs got enough listens. Anyway, let's move on, because retirees moving south for warmer weather now have another reason to migrate: their grandchildren. A quarter of baby boomer households plan to retire near their children and grandchildren, according to housing research firm Zonda, which publishes a baby chaser index. And in 2023, cities like Austin, Charleston, and Jacksonville topped the list. Joining us now to tell us more is Zonda's chief economist, Ali Wolf. Ali, thanks for joining us. This is actually a trend that you've first heard of some 6 or 7 years ago from home builders themselves. What did they tell you?
Exactly right. So builders were saying we had millennials that were coming into their, and the millennials were buying a home, and then they were saying, oh, by the way, here's also my mom, and my mom wants to buy a home as well. And so we ended up finding that millennials and their baby boomer parents were moving to some of the same parts of the country.
So the boomers, of course, hold a lot of the nation's wealth thanks to decades of stock market gains and rising home values. They can afford to move and buy homes in fast-growing cities. And in some instances, they're buying actual, freestanding homes. In other instances, they're buying townhouses, or maybe they're moving in with the grandkids and their children. I'm curious to hear from you, how big a structural change is this to household formation and the dynamic of supply and demand in some of these markets in the South or in the Sun Belt?
Well, what's interesting about these migration patterns is if you think about the millennials, they're often moving for affordability or for jobs. Traditionally, baby boomers were not moving to areas where there was high job growth. They didn't value that the same way as their younger children might. And so now what we're finding is actually where the baby boomers are moving to is where we have some of the stronger labor markets. And I think one of the most important things that we're seeing is that the baby boomers are saying, we'll help you afford a home. We call this the bank of mom and dad. They're saying we can help you some funds to help you be able to purchase a home today.
So this gets to this idea, though, too, Allie, when we talk about demographic shifts and how that feeds through into housing markets, is this going to be a meaningful enough shift that would actually address some of the housing affordability issues and housing availability issues, or is this still going to be kind of concentrated in areas that were already stressed?
Yeah, so what we need to know about the home builders need to feel comfortable that they're going to be able to sell a home to build a home. And so if you migration patterns and if you see that there are a lot of home sales in some of these higher growth areas, should in turn result in higher construction starts activity as well. So it's meaningful to try to address affordability because more demand can help support more home building.
All right, Allie Wolf, chief economist over at Zonda. We're going to leave it there. We were having some connection issues with Allie. We'll try to get her back on the program at another time and place. And I know you were really interested in talking to her about the baby index because, I mean, this is a big factor, right? Yeah. I mean, we talk about how these things, I mean, we kind of joke about it, but these things have material impact on the housing market and on the economy overall.
Right, and these baby boomers are in a position to pay cash a lot of the times. They're not as worried about where the mortgage rate is. So it definitely skews what's available in terms of supply, especially because their children aren't necessarily able to buy homes on their own. And as Allie mentioned, the bank of mom and dad. Yeah, the bank of mom and dad for eternity, apparently, until you're a mom and dad or granddad yourself here. And then it gets also to this issue, too. You know, I was working on a package about housing affordability. I was out in Las Vegas. And, you know, the big issue they've had was a lot of folks from California who are selling, you know, $1 million homes, moving to Nevada where you can get a home for under $500,000, and they didn't care about price as much. So they didn't mind getting into bidding wars because to them it was a bargain. But if you're a local, you're wondering why is this $300,000 house getting bid up to $500,000? So it becomes a really big issue. As I'm sure people in places like Florida or Charleston are thinking when these baby boomer grandparents from the Northeast come moving down. So I had to stop you right there, Scarlett, because I only have 10 minutes into the show. We've gone an hour and 50 minutes on this show, and we have not shown peaches and herbs. This is these are the two turkeys, Scarlett. We have this tradition here in the U.S. You might have known it. Thank you for explaining this.
We take these live turkeys. I love to mansplain things. We take these live turkeys. For some reason, we put them in a fancy hotel. Then we trot them over to the White House.
Wait, they stay in a hotel?
And yes, the Willard Intercontinental Hotel, which is a very pricey hotel. I don't know if they charge the turkeys for the room.
I don't want to stay in the room after.
And then, you know, the president waves his hand and he says, "I'll give you a pardon. You won't be eaten. You go off to a farm somewhere and live out the rest of your life."
And then what do these turkeys do? I mean, they're part of the chosen few, but what, they just hang out for the rest of their lives?
They do whatever turkeys do. I don't know what turkeys do. Have you ever? I don't know. I've never thought about what turkeys do. I mean, I've seen wild turkeys. They got those running around New Jersey. They're barbaric. I mean, they'll kill you. I think these turkeys are a little more docile.
Right.
So I don't know. Maybe they just hang out, you know, gobble around and have fun. I guess it's better than being on, you know, the big platter there.
Are you traveling, by the way, for Thanksgiving?
No, we made the very fortunate decision to actually host this year.
Oh, you're staying local.
So we're staying local. Though we're doing most of our, you know, we're not actually cooking. We're actually going to order a lot of stuff.
Smart.
Except for the bird. My wife insists on cooking the bird.
Okay, and you're just observing. You're kind of like hanging out watching football.
Yeah, don't tell my wife that. But yeah, that's the plan. All right, it's still ahead. We're going to set you up for what to watch over the next 24 hours. This is Bloomberg.
Season is here.
Third quarter earnings season, as we've been talking about, really in high gear.
Bloomberg is first to break the numbers.
We have some big earnings after the bell.
Earnings from Caesars crossing the Bloomberg terminal.
Mondelez is reporting
Reddit, AMD, Snap.
Let's keep the conversation going.
With the smartest insights.
The bar keeps getting higher. 20% growth rate. When your comps get tougher, how much can you beat and raise?
Continuing coverage on Bloomberg. Context changes everything.
All right, let's put your head to what the markets are going to have their eye on over the next 24 hours. And we're going to start about an hour from now. Neil Kashkari, Scarlett, scheduled to be on Bloomberg Television.
6 p.m. Eastern time. He'll weigh in. And of course, this comes right before we get the FOMC minutes. But I'm jumping ahead of myself. And you'll want to catch that at 6 p.m. Eastern time here in New York.
Are you enthusiastic about this?
Well, it's Fed speak, so I have to be, of course.
I'm just teasing you, Scarlett. All right,
I'm so excited.
We also get some earnings, too. A lot of the retailers reporting, including before the market. Best Buy and Abercrombie & Fitch.
Abercrombie & Fitch continues to be the darling, right? It's the 90s brand that has turned itself around and has kind of grown up with its customer base and done incredibly well by targeting women instead of men.
And it's interesting. You kind of wonder, can Gap see a turnaround? Or Burlington Stores, which is also scheduled to report. We do get some earnings out of Kohl's, which we just had some news on with regards to a CEO change as well. So a lot going on. And then aftermarket, quite a few earnings, including some consequential ones.
Yeah, Dell, CrowdStrike, and of course, we're always curious about CrowdStrike, given that whole cyber problem not so long ago and how it affected all these different clients.
And I'm curious about Nordstrom as well. Kind of interesting. We had kind of the preliminary report out of Macy's. They were supposed to report tomorrow, but obviously for a variety of reasons they can't. But we did see some of the struggles they're dealing with their legacy Macy's stores, although Bloomingdale's and Bluemercury are doing well. I kind of wonder how Nordstrom, which most people think is a little bit better department store in terms of the way it's run, I wonder if we're going to see those show up in the numbers.
But consistently, Nordstrom Rack seems to do better, or the prospects always look better than Nordstrom, the mainline. So it's curious whether at some point it might be cannibalizing the Nordstrom mainline sales.
That's a good point. 10 a.m. Eastern tomorrow, we're also going to get some economic data, new home sales.
New home sales, consumer confidence from the conference board, so that's going to be critical too.
And 2 p.m. Eastern time, we're going to get a peek here at the Fed minutes from that last meeting to see what they debated, Scarlett.
Lots of things.
Do you think it was really scrappy?
No, it's the Fed.
All right, join us tomorrow. We'll be back. Balance of Power is up next. This is Bloomberg.